In March of 2020, we literally experienced a V-shaped recovery of markets. For every dollar that was printed, the stock market went up 92 cents. Well, unfortunately, capitulation-style bear markets, like the one we're in now, could experience the complete opposite, especially since markets like this tend to bleed out through long, drawn-out bottoming processes. And the Great Reset may be on its way. Folks, something happened today that signals more doom and gloom to come. That's right, more FUD. And you need to know about it so you can be prepared. In fact, it's not just one thing we're going to talk about. We're going to talk about 3 very important things that we have to pay attention to help identify when are we potentially close to a bottom and how much more pain do we have to go. And no, I'm not talking about consumer numbers again. We already know from the Barclays report last week that the consumer is showing strong evidence, both in high incomes and low incomes, high being a problem as well because they're kind of keeping everything else propped up right now, but we're seeing a precipitous decline in credit card spend by both of these. Things must be so bad that Amazon is now pre-announcing that instead of having one Prime Day per year like they always have, generally around July 12th, which is when this year's is, Amazon has now announced that they're going to have a second Prime Day, sometime in the fall, a date not determined yet. Usually you only see that when companies' sales are plummeting, with the exception of our sales. Our sales for our programs on building your wealth are exploding because people are investing in themselves, and we're extending the coupon code that was supposed to expire on Friday to Thursday of this week, just because so many of you have reached out asking for an extension of just a few days. So it will be expiring on Thursday, and then the price will be going up again. But no, these are not what issues we have. There are 3 issues we have to pay attention to. The first big problem that happened today might be part of the cracks that we're starting to see because of quantitative tightening. Quantitative tightening is the process of the Federal Reserve trying to make this white line right here go down. See this explosion of the white line right here? This is when we printed money like crazy during the pandemic, and the Federal Reserve's balance sheet exploded by more than $6 trillion so that we can give out stimmy checks. Like California is still giving out stimmy checks in 2022 because somehow the way to fight inflation is by printing and giving away more money. But this is a problem. This is the Federal Reserve's balance sheet, and we need to get this white line probably down to right around here, the $5 trillion level from up here. That means we got a long way to go. And remember, the stock market went up 92 cents for every dollar we printed during this period of time here in 2020 and 2021. It was only about 3 months ago that the Federal Reserve finally woke up over here and stopped printing money. Well, folks, now we're starting to see cracks in the bond market potentially because of the start of quantitative tightening. Listen to this. This morning, we had the worst day in the Treasury market since December of 2010. Weak demand in the bond auction this morning, when there was a $47 billion 5-year note auction, was so bad that we saw a 3.5 basis point higher price than expected on the same day's bidding. That, in case it doesn't make sense to you, is totally fine. All you have to know is it was the worst amount of demand that we've seen for bonds and the worst mispricing in 12 years. That's a sign that quantitative tightening, even though we've just begun, is already starting to show signs of cracking markets. And this is probably why the stock market likely started turning red today as well. Again, we're just at this little process. That's all we've done so far. And we got to do that. That leads us to the second big problem. But first, a message from our sponsor. But first, I want to thank today's sponsor, Moomoo. Moomoo is an advanced stock trading platform that is offering all of my viewers up to 10 totally free stocks, plus a free Lucid stock when you open an account and deposit money using my link down below. And folks, each stock you get is worth between $300 and $2,500. So there's literally no reason not to get this free money when you sign up and deposit with Moomoo. Moomoo makes buying and selling stocks so simple and easy, while we're all able to get the relevant information and analytics that we need while we're investing straight with the Moomoo platform. No more needing to go to other platforms or news websites or whatever, because they offer advanced trading and research tools that are customizable with more than 60 technical indicators and 22 different drawing tools, which really helps with the countless hours I spend doing research and technical analysis. Moomoo gives you real-time quotes so you can be sure prices that you're seeing are up-to-date ones, not 15-minute delayed prices. And they also have no trading fees and also let you trade totally for free during their extended trading hours from 4 a.m. to 8 p.m. Let's get up to 10 totally free stocks plus an exclusive free Lucid stock today when you sign up using my link in the description down below. Again, link is down below. Get 10 free stocks and a Lucid stock when you sign up with Moomoo today. The second big problem that we face is the lack of preparedness potentially by retail and individual investors. Take a look at this chart here. On the top, it shows us a sentiment, not of consumers, but of stock exchanges. It's a measure of what the stock market sentiment is like. And take a look at how we've bottomed out. Here, 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 and here. But despite this crazy sentiment, where are retail positioned? Well, look at that. We're still 67.5% invested in this market. And that might be a little bit of a problem, but I don't know if we can be blamed for that, because if we look at analyst recommendations are at the highest levels that we've seen since 2002, and we haven't even gone into the earnings recession yet, or the actual recession where we actually see people spend less money and that shows up in earnings. Analysts can give ratings of between 1, a sell rating, and 5, a strong buy rating, right? The average analyst levels right now for consensus EPS, earnings estimates for companies, stands at a level of 4, which we have not seen that level since 2000 over here. How? How in the world are all of a sudden expectations for earnings this high going into a recession? It doesn't make sense. Now, again, you can't blame then investors for being in the market, especially since, and shout out to Trey, we do have some bullish signals. Trey posted this chart here showing that usually after we see these kinds of lows on volatility, we can oftentimes see new highs in the stock market, or at least have bullish weeks to follow. And so this makes for quite a confusing market. In fact, even though we saw the put-call ratio skyrocket over the last few weeks, we're now back to roughly average levels. So we go through these periods of extreme fear and then we kind of relax again. But this is also very common in bear markets. The big danger that we have to watch out for, though, is earnings, because earnings is expected to be the next big drag on stocks. And that's the third big problem that we have as part of this crazy reset that we're going through. Take a look at this chart over here. These are revenues in blue right here. You can see some nice revenue growth. These in red are price to earnings multiples. So we've seen a collapse in valuations of companies, obviously as multiples are plummeting. But what we haven't yet seen is earnings move down. And again, maybe analysts are right. We've seen this chart before. Earnings expectations have not been revised down. But the problem with that is anytime we've had large crashes, like here's the Great Recession right here, we always see earnings expectations come down. And it just has not happened yet. We're right here. And see, the blue lines are equity prices. The white line are consensus estimates. We saw it in the dot-com era, we saw it in the Great Recession, we saw it during COVID, we saw it at the end of 2018. We generally see earnings estimates go down. It's just for some reason not happening yet. And so when you combine all three of these things, you kind of have a little bit of a scary portrait. You're in the situation where you've got the treasury market's great reset that could be a big old problem when we go through the real quantitative tightening cycle. We've got people pretty bullish on the market, which, hey, you know what? I'm optimistic about the market as well. Maybe not in the short term, but of course in the long run. You've got retail in the market more than out of the market. You've got a lot of signals for reasons to be bullish, but we are not seeing those earnings revisions down yet, and it's a sign that the bottom just isn't here yet. So what do we do? Well, number one, patience. We're not even 50% through the year, so there's likely more pain to come for at least another 6 months, if not potentially a whole nother year. Number 2, prepare for companies to miss on earnings and potentially reposition to companies that can still grow earnings above expectations. This is where you can make a very strong case for Tesla. Even if you have cancellations of a lot of orders, Tesla expects to still grow earnings at 50%. We'll see what happens. Number 3, pay down debt. Don't get liquidated. You have to be a survivor during these times. Number 4, prepare yourself to buy real estate. Remember, we've got a brief extension on those programs on building your wealth through Thursday, link down below. Check out especially the real estate ones. And number 5, share this video if you found it helpful, and good luck.